Welcome to the deep dive. We take your sources, pull out the key intelligence, and basically save you from drowning in information. Today, we're tackling an asset that's, well, truly making headlines: gold.
That's right. As of October 2025, gold prices aren't just strong, they're, trading above $4,300 an ounce, really knocking on the door of historic records.
And this comes after a huge run-up, right?
Oh, absolutely. Depending on exactly when you start measuring, we've seen prices jump like 30 to even 60% in the past year alone. It's been quite extraordinary.
50%. Wow. Okay, so for you listening, whether you're already holding gold or just thinking about it, the big question is, well, it's pretty intense. With that kind of massive growth already baked in, is now still a good time to get in? Or should you hold tight? Or maybe even sell before a potential drop?
Exactly. And that's really our mission for this deep dive. We're going to dig into the big picture, the macroeconomic forces pushing gold up. We'll also look at, specific buy signals to help manage the timing risk, and crucially talk about how much gold actually makes sense in your overall portfolio for the long haul, making sure it helps, not hurts, your wealth goals.
All right, let's start there. The momentum. We're hovering near those all-time highs, $4,300 plus. What are the analysts saying? Is there still room to run?
Surprisingly, the general feeling is still quite bullish. Short-term dips are always possible, obviously, but the underlying trend seems really strong. Many forecasts are pointing higher, potentially even towards $5,000 an ounce sometime in 2026.
5,000. Okay, so it's not just momentum trading then. There are real reasons behind this.
Definitely. It's rooted in some pretty fundamental fears, actually.
Like what specifically? We always hear, gold is a safe haven, good for inflation, geopolitical risk. But what's different now? What fueled this, say, 60% climb?
Well, the safe haven appeal is definitely part of it. Global uncertainty, geopolitical tensions heating up again, that always helps gold. But the real engine this time seems to be real yields.
Real yields. Explain that a bit.
Sure. So when inflation expectations are high, but interest rates set by central banks are, relatively speaking, lower, you get negative real yields. It basically means holding cash actually costs you money in terms of purchasing power.
Right. Inflation eats it away faster than the interest you earn.
Exactly. And in that environment, gold, which doesn't yield anything but holds its value against currency debasement, becomes much more attractive. It's a classic hedge against that currency risk.
Okay, that makes sense. What about the US dollar? Usually gold goes up when the dollar goes down. But the dollar's been a bit mixed lately, hasn't it? How does that fit?
That's a great point. And yeah, that classic inverse relationship, it's weakened a little bit recently. But that's because there's an even bigger factor kind of overriding it right now: massive institutional demand.
Institutional demand, you mean like big funds?
Big funds, yes, but even more significantly, central banks. The amount of gold accumulated by central banks globally in 2025 is frankly historic. This isn't just routine portfolio tweaking. It looks like a very clear strategic move, especially by central banks in emerging markets, to diversify their reserves away from the US dollar.
Diversifying away from the dollar. It's a big statement. Can you give an example? Which countries are we talking about?
Yeah, absolutely. We're seeing really significant sustained buying from countries like China, Turkey, and India. Sources are pointing to, for instance, the People's Bank of China consistently adding, large amounts of gold month after month for the last several quarters. 2025 is shaping up to be one of the biggest years for central bank gold buying on record. And that kind of persistent, large-scale buying, it creates a really solid floor under the price.
Okay, that's good. Yeah, that's concrete. It puts a floor under it. But it brings up the next question for anyone holding gold right now. You're sitting on potentially a 60% gain in a year, and the analyst consensus is still just hold. Isn't that usually when advice starts shifting towards taking some profits, especially with $5,000 maybe still a year away?
It's a really valid question, and discipline is always crucial, right? You don't want to get greedy. But the reason the hold advice is prevailing is because those core drivers, the geopolitical risks, the central bank diversification, they look structural, they look long-term. So selling now might mean missing out on further upside that's driven by these, bigger, slower moving forces.
So what about pullbacks?
That's the key. Analysts are generally viewing any short-term corrections, maybe say 5% or even 10% dips, not as a reason to panic sell, but actually as potential buying opportunities, windows to add to your position if you're underweight.
Okay, so hold and maybe use dips to buy more. That implies timing becomes really important if you're putting new money in, right? You don't want to buy at the absolute peak after a 60% run.
Precisely. Timing risk is definitely elevated right now.
Which brings us nicely to our second section. how do you time this? How do you approach adding gold when the price is already so high?
Okay, so for anyone completely new to gold or maybe looking to gradually build up that 5-7% allocation we'll talk about later, the simplest way to manage timing risk is just dollar cost averaging, DCA.
Spreading your buys out over time.
Exactly. Or using fractional buying if your broker allows it. You just commit to buying a certain dollar amount regularly, say every month or quarter. It smooths out your entry price and removes the psychological stress of trying to pick the perfect bottom.
Makes sense for building a core position.
Mhm.
But what if you want to be a bit more tactical, adding during those dips you mentioned? What signals should you look for? Let's start with the big picture, the fundamentals.
Okay, fundamentally, forgetting the day-to-day chart noise, you're looking for a couple of key macro shifts. First, and this is a big one, clear signals of impending rate cuts from major central banks, like the Fed.
Why rate cuts specifically?
Because falling interest rates directly reduce the opportunity cost of holding gold. Gold doesn't pay interest, right? So when yields on bonds are falling, the fact that gold doesn't yield anything becomes less of a disadvantage. It makes gold relatively more attractive.
Okay, rate cuts. What's the second big fundamental sign?
Fears of stagflation taking hold.
Ah, the dreaded S word. Slow growth, high inflation.
Exactly. Gold historically performs very well in that kind of environment. So if you start seeing economic growth indicators weakening, but inflation numbers staying stubbornly high, that's a pretty strong fundamental green light for gold.
Got it. So those are the why now fundamental triggers. But let's get tactical. We see a 5 or 10% pullback.
Yeah.
How do we know if this is the dip to buy or if it's the start of something bigger? We need technical tools, right?
Absolutely. Technical analysis helps you manage the win, and the first indicator to check during a pullback is usually the relative strength index, or RSI.
RSI measures momentum, right? Overbought, oversold.
Precisely. It gauges the speed and change of price movements. A common buy signal emerges when the RSI dips below 30.
Below 30 means?
It suggests the asset has become technically oversold during that pullback. The selling pressure might be exhausted. Alternatively, if gold just had a really sharp rally and the RSI spiked way up, say above 70 or even 80, meaning it got overbought, you need to wait for it to cool off. Let the RSI come back down, maybe below 50, before considering adding more. Don't chase the peak momentum.
Okay, RSI gives us a sense of momentum exhaustion, but sometimes indicators give false signals. What else can confirm that maybe the dip is ending and the uptrend might be resuming?
Good question. You want confirmation. That's where you can look at things like moving averages and momentum oscillators. Specifically, check the MACD, the moving average convergence divergence indicator.
MACD, what are we looking for there?
You're looking for a bullish crossover. That's when the MCD line crosses above its signal line. It suggests that the shorter-term momentum is turning positive again relative to the longer-term trend, confirming renewed upward pressure.
And what about the classic moving average crossover, the golden cross? Is that useful here?
It is, yeah, but it's more of a medium-term confirmation signal. The golden cross happens when a shorter-term moving average, like the 50-day, crosses above a longer-term one, typically the 200-day.
So that confirms the trend has really shifted upwards.
Exactly. It tells you the medium-term trend is now decisively positive compared to the long-term trend. It's a strong sign the uptrend is likely resuming after a consolidation or correction.
Okay. One more technical tool for those deeper, maybe scarier 10% pullbacks. Fibonacci levels. How do traders use those?
Right. Fibonacci retracements can offer disciplined entry points during corrections within a larger bull market. You basically draw the levels from the previous low to the recent high. During a pullback, you look for the price to find support at key Fibonacci levels, most commonly the 38.2% or the 50% retracement level.
So if the price pulls back, bounces off that 50% level, and starts moving up again.
That's often seen as a sign that the correction has run its course, the weak hands have been shaken out, and the primary uptrend is ready to continue.
So ideally, you'd see a pullback, hit a Fibonacci level, the RSI dip below 30, maybe get a bullish MCD crossover, and you have those fundamental tailwinds like rate cuts coming.
That's the sweet spot. When multiple signals align technical support, oversold conditions, returning momentum, and supportive fundamentals, that gives you the highest confidence entry point.
Fantastic. Okay, that's a solid toolkit for timing.
Yeah.
So let's say we've decided to buy, we've picked our entry point carefully. Now the big question, how does gold fit into the overall portfolio? Because let's be honest, gold isn't usually seen as a primary growth engine like stocks, right?
Right.
It's more about stability.
You absolutely hit the nail on the head there. The primary role of gold in a modern portfolio isn't really about chasing high returns. It's about managing risk. It's a stabilizer.
How does it stabilize?
Well, because it tends to be non-correlated or have very low correlation to traditional assets like stocks and bonds, gold's beta, which measures its volatility relative to the market, is typically very low, somewhere around 0.15 to 0.19.
Meaning when stocks are tanking?
Gold often holds its ground, or sometimes it even goes up slightly. It zigs when other things zag.
So adding it reduces the overall roller coaster ride of your portfolio.
Exactly. Historical data shows that adding even a modest amount of gold can significantly reduce overall portfolio volatility. It tends to improve your Sharpe ratio, that's your return per unit of risk, mainly by lessening the severity of maximum drawdowns during market crises.
Okay, crucial distinction. It's about smoother returns and downside protection, not necessarily higher returns overall. So what's the right amount? How much of this stability insurance do we need?
Research generally suggests a modest allocation is best. Somewhere in the range of 4% to 10% of the total portfolio seems to provide the diversification benefits without significantly dragging down overall returns.
4 to 10%. Is there a sweet spot within that range?
Yeah, for most investors with a sort of moderate risk tolerance, the sweet spot often cited is around 5% to 7%.
Okay, 5 to 7%. Can you give us a practical example? Like, how would a standard 60-40 portfolio change?
Sure, instead of the classic 60% stocks and 40% bonds, you might shift to something like a 5-5-3 five-tone split. So 55% stocks, 35% bonds, and 10% gold.
And what does that 5-5-3-5 tuna mix achieve?
Studies suggest that kind of blend can still generate solid long-term annualized returns, maybe in the 6.5% to 7.0% range over 10 years, similar to the 60-40. But, and this is the key, it often does so with noticeably smoother performance, less volatility and shallower drops during those inevitable market downturns.
Makes sense. What happens if someone gets a bit too enthusiastic about gold, maybe goes up to, say, 15% or 20%?
Then you start running into problems. Allocations much above 10% can actually begin to increase overall portfolio volatility counterintuitively. And more importantly, they really start to drag down your portfolio's income potential. Gold pays no dividend, no interest. So over-allocating to it dilutes the yield you'd get from your bonds and dividend stocks, which can hinder your long-term compounding.
Right. Keep it modest. 5 to 7% is the target zone for most. Okay, let's talk implementation. For most people, buying gold means buying an ETF. The two big ones are GLD and IAU. What's the difference?
It mainly comes down to a trade-off between liquidity and cost. GLD, the SPDR gold shares, is the original and the biggest. Huge assets under management, like $143 billion, massive daily trading volume, very liquid.
Good for big traders, institutions.
Exactly. If you need to move very large amounts quickly, GLD's liquidity is attractive. But that comes at a cost. Its expense ratio is higher, currently 0.40% per year.
40 basis points.
Okay.
And the alternative, IAU.
IAU, the iShares Gold Trust, is the main competitor. It's smaller, maybe $80 billion in assets, still very liquid for most individual investors, but its big advantage is cost. Its expense ratio is significantly lower, only 0.25%.
0.25 versus 0.40. That's a 15 basis point difference.
Yeah, and that might not sound like much, but over 10, 20, 30 years of holding, that cost difference really compounds and eats into your returns. So for most long-term buy and hold investors focused on strategic diversification, IAU is generally the more cost-efficient choice.
Okay, lower cost with IAU is a clear win for long-term holders. Now, we have to address the elephant in the room with these gold ETFs, taxing.
Yes. This is absolutely critical for anyone considering holding these in a regular taxable brokerage account. Both GLD and IAU, because they hold physical gold bullion, are classified by the IRS not as regular securities, but as collectibles.
Collectibles, like baseball cards or art. What?
It's because the underlying asset is a physical commodity. The fund structure involves direct ownership of the metal. And under current U.S. tax law, gains on collectibles are taxed differently than gains on stocks or bonds.
How differently?
Significantly differently, and not in a good way. Long-term capital gains that's on assets held for more than 1 year on collectibles are taxed at a maximum rate of 28%.
28%. Compared to the standard long-term capital gains rates on stocks, which are typically 15% or 20% for most people.
Exactly. It's a much higher tax burden on your profits if you hold these ETFs long-term in a taxable account.
Wow, that's a major consideration. It could wipe out a chunk of your gains. So what's the workaround?
The most straightforward solution is to hold your gold ETF allocation within a tax-advantaged account if possible. Think IRAs, traditional or Roth, or potentially a 401k if it offers access.
Holding it inside an IRA avoids that higher collectible tax rate.
Correct. Inside a tax-advantaged account, the gains grow tax-deferred or tax-free, depending on the account type, bypassing the 28% collectible tax issue altogether. You get the diversification benefits without the tax penalty.
Okay, that's hugely important advice. If you can, put your IAU or GLD in an IRA. All right, let's try to bring all this together. Let's synthesize this deep dive. We've got gold near record highs, potentially heading towards $5,000.
Driven by structural forces, yeah. Not just temporary inflation fears, but significant central bank buying as a dollar diversification play, plus ongoing geopolitical uncertainty.
And the strategy seems to be patience and discipline.
Pretty much. The consensus leans towards holding that core position, likely in that 5 to 7% range we discussed. Don't chase these big green candles. Instead, use those inevitable pullbacks, maybe 5–10%, as opportunities to add if the technicals line up, like an oversold RSI, maybe bouncing off a Fibonacci level, and if the macro picture, like falling real yield, still supports it.
And for implementation, prioritize the lower cost ETF, probably IAU, and try your best to hold it in a tax-advantaged account like an IRA to avoid that nasty 28% collectible tax.
That sums it up well. It's about using gold for its intended purpose.
Which is fundamentally
Risk mitigation. Remember, its primary value is its low correlation to other assets. It's there to smooth the ride, reduce volatility, and protect your portfolio during major market shocks. That's the job.
That unique role brings us to our final, maybe provocative thought for you to consider as you weigh all this. If gold's number one job, its core value proposition, is this unique risk reduction, smoothing volatility, limiting drawdowns, hedging currency risk, does that essential insurance-like benefit perhaps make the higher 28% collectible tax rate a strategic trade-off you might be willing to accept, especially if you simply don't have room in your IRA and have to hold it in a taxable account?
It's a tough calculation, right? How much is that downside protection worth in after-tax dollars?
Something to definitely mull over as you finalize your own gold strategy.